Hi, this is Troy Patton with Patton Associates. Thank you again for joining us for this free CPE credits. Today I'd like to talk to you about how to consult on valuations without being an expert in valuations. For instance, maybe you don't have an ABV designation, which is the Accredited in Business Valuation designation, although I assume most of you are CPAs at this point, needing your CPE hours. But I think there's some good things about the valuation industry right now that are going on, and frankly there's a lot of need. And oftentimes, working with your clients on a day-to-day basis, there's going to be times that you're going to need to know a little bit about business valuations to consult with your clients. So what we want to teach you to do is really how to consult on valuations without being an expert in valuations. Okay? So some of the things that we're going to talk about today, and again, here at our firm, at Patton Associates, we prepare approximately 6 to 8 valuations per month. And we're going to show you a sample of the valuations that we prepare and the key factors inside of each of those valuations. And hopefully you'll gain a better understanding of not only the valuation process, but also some key and critical things that you should know about valuations, so that when you're talking to your clients, you can talk not only intelligently, but comprehensive enough that you're covering most of the critical aspects of a valuation and be that consummate advisor or that 20,000 foot level consultant. So let's just kind of get to it here. One of the gentlemen that's going to join us in this video, his name is Tony Patrick. He's an AVA, Accredited Valuation Analyst with our firm, and he assists in preparing the valuations as well. Patton Associates, we've been around for, approximately 10 years. I've been a CPA. I started my career with Ernst & Young and really learned the valuation process. Started doing valuations in about 1998 in a previous firm that I had. Along those lines, we learned many things about the valuation process and ultimately wrote our own macro Excel package to prepare valuations, because we felt it was imperative not just to use a canned program, but to actually understand the valuation process even better. And although it took a little bit of time, it's really worked in our best interest, as we work not only with CPAs like yourself, but with attorneys and that sort of thing. And we can create a valuation almost for any instance or any circumstance. And so I would encourage you, if you become a valuation expert at some point in time, you may want to come up with your own templates designed to create your own valuations, although there are many good packages out there from many of the software providers. Okay? If you would like to become a valuation expert, one of the things that I would advise you to do first and foremost is to get some kind of designation, whether it's your CVA designation or your ABV designation. And to do that, is what you'll need to do is you'll need to take a study course, approximately 40 hours. They're offered around the country. They also do have a self-study course with the AICPA, and it will teach you how to become licensed in valuations. But one thing you will need to do is have approximately 40 hours of CPE. I think you need to have 60 hours of CPE in any given 3-year period, specifically on valuations, to maintain that designation. Okay. You'll also need to subscribe to many data platforms, whether it be BizComps, Ibidson, MergerStat. There's a lot of different data programs out there, and we subscribe to, I don't know, probably about 10 different data sources. Everything from Dun & Bradstreet, again, to some of the mentioned products before. But again, you're going to need a lot of different data sources, and we'll cover some of those in this talk that we're going to give to you today. So one thing that we always talk about, first and foremost in the valuation arena, is why someone would even want a valuation. Okay, we have a product, and actually we're just going to share it with you. It's called 9 Reasons Why You May Want or Need a Business Valuation, and it's out on the website at I believe it's out on the website, pattonvaluations.com. You can see it here on the screen. We're going to input it in here for you. You're more than welcome to copy that. use it as your marketing material. We use this specific marketing material to put into every corporate tax return that goes out of our firm, because we feel it creates questions from folks on the valuations, on valuation processes, why they need a valuation, etc. So just to cover these 9 items, and some of them are very similar, but the very first one is probably one of the biggest reasons why we prepare valuations. And the first one is marital dissolution. Unfortunately, I don't know what the divorce rate is here in the country, but it's probably 20-30%. It's fairly high. And oftentimes, or even not so often, you may run across 1 or 2 of your clients that are getting a divorce on an annual basis. And occasionally one of those folks will have a business interest, or they'll own a business, a small business. Anytime that there's a marital dissolution, you will need to have a valuation of that business, or come up with some kind of valuation number for that business, because that's part of the community assets that are going to be split amongst the husband and wife. And no matter which one owns the business, it's still, the process is still the same. One thing that unfortunately we get involved with marital dissolutions is oftentimes it's not just the valuation process or coming up with a valuation, and this is one area that you want to key in on, because it's something that you need to be aware of when preparing a valuation or giving someone a number for a valuation, even if you think you want to give them one page, a one-page valuation. Sometimes you will be called to testify to support that valuation, support the data, the empirical data that supports the number that you've given to your client. And if you're not a valuation expert, I would forewarn you that you may have to have some very comprehensive work papers to back up your information, not just using a rule of thumb saying, hey, this business is worth 3 to 5 times earnings. Because unfortunately in the courts, those don't work all that well. Okay? One thing that is very common also in a marital dissolution case is when we're preparing a valuation, each state that we live in has different rules as to the definition of value. One may use fair value. One may use fair market value. Another one may use marital value. We see that oftentimes on the West Coast and certain other states. But each state has case law that dictates how you establish the value. And you need to be aware of that, because it's very common, and we've seen it oftentimes, especially in courts, when we're giving depositions or when we're in front of the judge and we start talking about a value and the other party is using a value, but that value is not used in the state that we're in. Okay, so that's something that you need to be aware of. That's just another database again that we subscribe to that provides case law, recent case law in terms of marital disputes and other things. Okay. Okay. The second reason that we have listed on here is estate and gift tax. Obviously, we're in 2011, 2012. That estate tax, I mean, the value is $5 million, but it's supposed to revert back according to what we believe is going to happen in estate and tax law. And we do a lot of gifting valuations for business owners that are ready to transfer ownership to whether it be to children or to family members or to anyone else. So oftentimes we do valuations for estate and gift tax. Another reason that your client may need or want a business valuation is for shareholder buyouts and disputes. Okay. Obviously these aren't quite as common, but unfortunately they are somewhat contentious at times, as one party believes the value of a business is X and the other one believes it's Y. As you can imagine, in marital dissolution that happens as well. For buy-sell agreements, bringing on a new partner or new shareholder into a corporation, that'd be another reason. Sub-S conversions. One thing that you need to be aware of in a sub-S conversion is what's called the BIG tax, BIG, built-in gains tax. So we often do valuations for people going from a C to an S corporation. that would be another reason why you may want or need a business valuation. Bankruptcy, whether a business, especially in today's day with the economy sputtering along, we've often had banks call us for to do valuations on bankruptcy to see that there is no value or is value in a certain business before they foreclose upon a loan. Okay. The next one is financing. The SBA requires a valuation of some sort for certain types of SBA financing. Okay, we've done them for board meetings and for personal planning, financial planning, just for business owners in general. Okay, so those are 9 reasons why you may want or need a valuation. Obviously, there's others, but those seem to be the more prevalent reasons that someone may want or need a business valuation. Okay. The next thing I want to talk about is what is in a valuation, and obviously this is pretty important. And one of the things that Tony's going to discuss on the business valuation when he goes through the actual sample that we have out on patentvaluations.com is, and we're going to use the construction industry sample valuation out there. I think we have 6 or 8 of them out there for you to take a look at. But it's one thing that would be probably very helpful for you in terms of an educational standpoint and to make you that consummate advisor is to go through those valuations. Read them, get to know them, understand the different areas that are in those valuations. And it will help you to consult on valuations, and you'll understand things like the normal compensation and the projecting out of cash flows and working capital needs and things like that. And then obviously at the end, as Tony will point out, is the gut check. Basically saying, is this a financeable deal? I mean, would a bank finance this valuation based on the premises of the value that we've dictated in our report? So some different areas that are in evaluation, and I'd just like to point this out. Okay, and before I do, I'm sorry, I want to backtrack one instance here. Is we also have another report. It's called 3 Things That Every Accountant Should Know About Business Valuations. And again, that's out on the website, on the patentvaluations.com website. And again, these are free. You're more than welcome to download them and take a look at them and see what those reports are all about. And we have a quick little education series on valuations that once you pull that report out will help you to be a valuation expert or to be an expert without being a licensed valuation expert per the AICPA. What is an evaluation? Well, one thing that we have to do in evaluation, the AICPA Statements of Standards Evaluation Services #1 says there's certain things that we have to do in evaluation. Okay, and there's certain things that we need to understand, and one, obviously we need to understand the engagement, but we also need to understand other aspects of the valuation and what needs to go into the valuation, or what we need to consider before coming up with a value. And one of those things that we need to know is we need the empirical data of the subject that we're taking a look at. That's, typically it's 5 years profit and loss on a cash or accrual basis. Maybe it could be tax basis, all right? We need to have the balance sheet. Basically any data that's empirical, and by empirical I mean it's undisputable. I mean these are the data fact sets that we're going to be using to create our valuation. Now we do understand that on some of those valuations we need to normalize the expenses. For instance, if you're doing a valuation on my company and I'm running through a boat that I have in Tahiti, obviously that would be one thing that we might want to back out. All right, but we're going to take a look at that empirical data and we're going to put it into, in our case, the way we do it is we put it into a spreadsheet. And we want to take a look at that empirical data and, one, make sure that it makes sense. Is there too much cash on the books? Is accounts receivable over the averages, over the norms that we see in like companies? And we're going to use that empirical data then to create projections and working capital projections for the next 5 years. And if the subject client doesn't have projections for the next 5 years, then one thing you want to make sure that you have a good understanding of is what the long-term expected rates are for that industry, because you're going to have to create some kind of projections. All right. The next thing that you want to you're going to need to calculate is what's called the capitalization rate, or cap rate, and the discount rate. And in our instances, what we're going to do is we're going to show what's called the build-up method in our report. Okay, we're using the build-up method to come up with a discount rate. There are other ways to come up with a capitalization and discount rates, but we feel that the build-up method, although all of them have some amount of subjectivity, the capitalization rate and discount rate using the build-up method is just as reliable as using like-kind companies, because you're going to need to formulate some decision, and the build-up method is a widely used method. It's widely recognized in the courts and that sort of thing. Okay. Lastly is normalization. We need to normalize all the numbers. Again, like I gave the example about the boat. For instance, you may have a company where the owner is only paying themselves a $24,000 salary and putting a big number to the bottom line, or vice versa. Maybe they have all their kids on the payroll. Okay, we need to take a look at those things. We need to back out the everything from debt that is not associated with the business, assets that are not associated with the business, excess cash on hand that's not needed to run the business, but maybe they're just leaving it in the company. Okay, and we need to do what's called a normalization process of all these expenses, balance sheet items, literally across the board. Okay, so just as a quick teaser to you, what do you think at this point? I know I've been talking for a while here. What do you think is the most important part of the valuation? Okay, is it the empirical data? Is it the projections, the cap rate, normalization? We haven't even got into the different methodologies, but what do you think is the most important part of the valuation of this process? Okay, well, the answer is all of the above, right? Because if you have any area that skews your numbers at any point in the valuation process, it's going to give you a result that is going to be unsupportable, or it's going to be refutable by another party. Okay? So with that, I'd like to turn it over to Tony, and what I want him to do is talk about the methodologies of the valuation, the different methodologies that we use, and then take you through a sample. Okay? Thank you. And I'll turn it over to Tony at this point.
Hi, I'm Tony Patrick with Patton & Associates. I want to thank you for joining us today for the video on how to consult on value without being a valuation expert. As Troy had previously discussed, he presented an overview of the valuation process, some certain things that would be important for you to review with your clients as you're discussing the value of their businesses and the certain aspects or issues that they face when valuing their business. I'm specifically going to go into the engagement process, the valuation process, talk about the various components of a business valuation, how it is that I go through the valuations, the process, the components, and then after we do that, then I will take a look at the valuation report, the sample valuation report that's available online for you to review. And at some point, we'll go specifically to that valuation report, and you can take a look at it as I'm discussing it. At this time, I want to talk about the process, and there is a specific process that I go through when I am first contacted by a client or a prospective client. And the first thing that's going to happen is a phone call or a face-to-face meeting with the client or with the client's representatives to discuss what it is that we're valuing, why we're valuing it, and those specific issues. And from that discussion, I would then draft an engagement letter. And it may seem like a very basic component of the valuation process, but this is a key component because if mistakes are made here, there will be issues down the road because expectations won't be met from the client, from you to the client. So in an engagement letter, it's very important that you clearly outline what it is that you will be doing throughout the process. What is the name of the entity? What is the valuation as of date. That is a very, very important component to this. You need to know as of what date are you valuing. Next, you want to know what percentage of the business that you're valuing. Is it 100% of the business, or are we talking about a 50% ownership interest, 25% ownership interest? Again, that's a very, very key component of the engagement letter. It's significantly important because a 10% ownership value is not 100% divided by 10. There are various discounts that are associated with a 10% value versus 100% value. So you need to know what that is. In addition, you're going to need to know what the standard of value is. I know Troy, when he was just talking with you, there are various standards of value in business valuations. For instance, there's fair market value, or there's fair value, there's intrinsic value, there's investment value. There's probably a half a dozen standards of value that are used in valuations, and it's important to know which one you're using, especially if it's going to litigation. You want to make sure that you're using the right standard of value. The next component of an engagement letter is going to be the premise of value. Are we talking about a going concern? Are we talking about liquidation? Are we talking about some other premise of value? And again, there's several different premises of value, and you need to know which one you're using, and that needs to be clearly outlined in the engagement letter. And lastly, you want to, in the engagement letter, outline what is the purpose of the valuation. When you're valuing a company, you want to make sure that it's understood that the value of this company that you're completing is for the purpose of a divorce, or it's the purpose that it may be attached to a buy-sell agreement, or that it may be associated with estate and tax planning. All of those is very important because the value of a company may not be the same with one purpose versus the purpose versus another purpose. And so again, that needs to be outlined, and it needs to be clearly outlined that you are valuing this company for a specific purpose, and this valuation should not be used for any other purpose unless you sign off on that, or the valuation analyst does. So again, that's the engagement letter. You should never go into evaluation without a clearly drawn out engagement letter. I know we're not, a lot of you aren't looking to become valuation experts, but you will be representing your clients, and you need to make sure that you understand what's in the engagement letter as well. So moving forward, the next component, once you are fully engaged with the client, you then will request information. I typically request 5 years of historical information related to the income statements, balance sheets, tax returns. I want to get as much information as possible. In a lot of cases, it is difficult to gather the information, as you know, but especially when you're going back 5 years. But you try to get as much information as possible. So what I do is once I get that information, then I'm going to take some time to do a preliminary review of the financial statements to formulate some initial questions. Some things that maybe jump out at you, numbers that may or may not be in line with industry norms. And related to that, I always gather an industry report. And there are several companies out there that provide industry reports that provide an overview of the industry as well as the outlook of that industry. And so what I'll do is I will review the industry reports that they also contain financial ratios and norms of that industry, and I'll compare the subject company with the industry norms and the data that's obtained in those reports. And from that, I will develop a list of questions or things that I would like to discuss with either the owner of the company or key management personnel, or in a lot of cases, I will have those discussions with the company's CPA or accountant. And from those questions, I will develop a better understanding of the company, its position within its market, as well as some of the strengths or weaknesses of that company. Those strengths or weaknesses could be related to the size of the company relative to other businesses in its market. Could be things such as employee turnover, issues related to litigation, could be quality and depth of management. Again, there's a list of questions. I have probably 40 standard questions that I'm going to talk to with a client, but then additional questions are developed through the initial analysis or preliminary analysis of the financial data and the industry reports. Once I gather all of that information, I am now going to go back to the financial data and make some normalization adjustments if they're necessary. And I'm going to take a step back here because really it's key for you to understand why what we're doing here. And I'm trying to insinuate that that you don't understand why evaluation or what's going on in evaluation. But what I'm trying to do through these first few steps is determine the risk of this company. The risk of this company relative to other investment opportunities, relative to other businesses, similar businesses. What are some risks? Because from all of this information, we're going to develop capitalization and discount rates that we'll talk about in detail a little bit down the road. So going back to where we are now analyzing financial data to make any necessary normalization adjustments. And those adjustments are key. Some of the big ones that may jump out at you are going to be adjustments for owner's compensation. I know Troy talked about this in his presentation earlier, but these adjustments are basically made to determine if the owner or key officers that are receiving owner's compensation or officer's compensation, if they are removed from the company, what would it cost to replace that person to fill those specific job duties. So when I get information that says, well, this, Bill Smith is the owner of XYZ company and he makes $250,000 a year, I need to know what Bill Smith does. What are his basic responsibilities? Is that compensation that he receives too high or too low for the specific job requirements or duties that he's responsible for to the operations of that business? And so I will make adjustments either higher or lower to normalize those financial statements. Some other normalization adjustments are going to be related to the balance sheet. When we're talking about the balance sheet, as you know, those items on the balance sheet are book value. And so I need to have a better understanding of what the fair market value is for those assets listed on the balance sheets. So is there any land or real estate associated or listed on the balance sheet? And if there is, has the fair market value been determined by another appraisal? And that would be key. For instance, we may be talking about a manufacturing plant that has a significant amount of real estate or equipment listed on the balance sheet. It's critical to determine what the fair market value is. Now, it's not the valuation analyst or my role to determine what that fair market value is. That would be outside the scope of what is being done. So in that case, if there are a significant amount of equipment or real estate associated or listed on the balance sheet, an outside party would need to complete an appraisal of those assets to determine the fair market value. And then adjustments need to be made on the balance sheet in the business appraisal report. Also, some other normalization adjustments that would be on there would be, for instance, I know Troy talked about I believe it was a boat or a house in Tahiti that he or may or may not own. That would have to be removed. Any other non-operating asset would need to be adjusted off the balance sheet to normalize the financial statements. Any excess cash, anything that looks out of line. For instance, if a company has typically $250,000 of accounts receivable, about that somewhere over 3 or 4 years, then all of a sudden that's inflated to $1 million. You need to know what that is. That could be something that is that was just posted on accounts receivable that will be paid, and it definitely needs to be adjusted because that's going to have an impact on working capital. It will also have an impact on other ratios that you're going to determine, the current ratios, quick ratios, things like that. Other normalization adjustments that would be taken into consideration would be any discretionary expenses on the income statement. If we're talking, for instance, about a dental practice or some type of practice, are they running a bunch of non-business expenses through the business for of course, for tax purposes? If that's the case, adjustments will need to be made to normalize those financial statements. So again, that is a key component, because if you don't make those normalization adjustments, if you don't go back to the financial statements and try to get a better understanding of what they should be for the operations, your end conclusion is going to be off, and the value that you provide is going to be incorrect. Okay, so now we've made our adjustments to the financial statements. We've created a financial statement that would be considered normal for either the business and or the industry. So you really want to have a good starting point. So that's where we're going now. And the next thing that we want to do, that I typically do, is then go into the capitalization rates and discount rates. Because this is, again, a key component of what we're doing in the business valuation. When I do my business valuations, probably 95% of the time, the way I determine capitalization and discount rates is what they call a build-up method. And I know Troy briefly discussed that with you. Either the build-up method for capitalization rates is a widely accepted methodology for determining capitalization rates. It's based on a series of premiums that are added to risk-free rate of return. We're going to go into this more specifically when we actually review a valuation report, and we'll go to that section so you can see it, and then I'll talk about it a little bit further so you have a better understanding of how these capitalization rates and discount rates are created. From those capitalization rates and discount rates, the next step is to go into the valuation calculations. Now, as you know, there are three main approaches to value, and the first approach is going to be the asset approach. The next would be the income approach, and the final is the market approach. And within these three main approaches, asset, income, and market, there are several different methodologies to determine value, that calculate value. And based on the type of engagement, the reason for the engagement, the specific characteristics of the subject company, at that point, the analyst is going to determine which of these methodologies would be best suited to determine the value of the subject company. In our case, what I like to do is to lay out as many different methodologies that make sense. I may not incorporate all of those values, those methodologies, in the end result, but what I want to do is illustrate to my readers what the value would be for these specific methods. And we're going to go into that again in more detail when we get into the report. But it's important because each reader has a different perspective, but you want to help them get a better understanding of the value and then explain which of those methodologies are incorporated in the value, determining value, and why you use those. After you then calculate the values, then you are going to determine and apply the appropriate discounts in that specific case. And the discounts are basically a marketability discount and what they'll call a minority discount or a lack of control discount. And what these are, the marketability discount basically is to determine what the value, the discount to value should be, because you have an illiquid asset. A company is an illiquid asset as it compares to cash, or as it compares to a stock on the open markets. If you want to sell a stock, you contact your financial representative and say, I want to sell 1 share, 5 shares, 10 shares of a specific stock, and boom, you've done that. You can't do that with a business, and so there needs to be a discount to that value, and we'll go into what those marketability discounts could be, what the range of discounts are, and why you would increase or decrease these discounts. And then we have a minority control discount, lack of control discount, and those are taken when you're valuing a percentage of the business that's less than 50.1%. And you have some analysts that say it should be anything less than 50%. I personally feel like anything less than 50.1, you have to take some type of discount, because if you have 2 partners and they're equal owners of 50%, making decisions isn't as easy as just saying, I would like to sell an asset, acquire an asset, change business operations. You need to agree on it before anything could be done, and therefore that 50% value is a non-controlling value or non-controlling share of the business to a degree. So we'll talk about minority control discounts as well. Once I do all of that and I determine the end value, apply the discounts, I am then going to do what we call a sanity check. And in most cases, my sanity check is, if I was to sell this business, or if I wanted to sell this business, could I find a bank to provide the financing to purchase this business? And there are various different ratios to determine. You want to make sure you understand how banks lend to this industry. Is it 100% financing? Is it 80% financing? Is it 50% financing with 30% seller carryback plus 20% holdback? You just have to have an understanding of how banks lend to the industry and apply those different factors to a hypothetical purchase, and make sure that cash flows meet lending requirements, debt to equity ratios meet lending requirements. And if all of those fit under bank guidelines, then you can feel comfortable that the value that you've concluded is acceptable. Now, there are other sanity checks. One of the most basic sanity checks is what we call a rule of thumb. For instance, it could be a rule of thumb, for instance, in the dental industry, dental practices sell for 0.6 of gross sales. That would be a rule of thumb. It doesn't mean that the value at 0.6 is actually the value of this business, but it could be something. If it's far off of a rule of thumb, you then need to kind of go back and determine why that is. And it could be because this particular business is excessively high profitable or excessively low, and it's going to impact the value. So you want to make sure that you provide those sanity checks, and the sanity check that we do is always listed in our report to make sure that everybody is comfortable with the end result. So at this point, what I'm going to do is refer to the valuation that I completed a few months back. Of course, all the names and all the specific characteristics of the company have been changed, but I want to go into this valuation, show you some key areas, make sure you have a better understanding of the areas that you should be looking at, so as you're consulting with your clients, you can give a better explanation of where the numbers come from and how they're calculated. Okay, so at this point we're going to take a look at a valuation that was completed a few months back for a construction company. As I mentioned, all of the information's been changed, but related to the company name and contact information. But it is for a company that we'll call Father and Sons Construction, and we're going to go through several areas of this report. We're not going to review every page, but we definitely can go through it. If you have any questions about anything you see, please feel free to contact me. You can send me an email at tony@pattonandassociates.com, and I'll be glad to answer any questions that you may have. So, again, this is just the cover page. On the cover page, we're talking about just basic information valuing Father and Sons Construction as of August 31st, 2010. Table of contents will follow. And then this next page is that lists the purpose and approach of the valuation. And this information, if you recall, is from the engagement letter. It's pulled from that engagement letter. It's again, as I mentioned earlier, the engagement letter is a key component. And here, basically, we're taking that information and laying it out. So again, the reader of this valuation report can have an understanding of what entity we're valuing, what percentage, so you see the percentage here, what percentage of the value of the company we're valuing, and then as of August 31st, 2010. And then the valuation in this case is to assist the principals in establishing market value in connection with corporate planning and may accompany a buy-sell agreement. Again, this is telling you specifically why you completed this valuation, and basically says that it shouldn't be used for any other purpose other than what's listed here. The next sentence is also important. This company is closely held. The interest considered is not marketable and has no liquidity. Again, it's not like a stock on the market. It's not like cash. This asset that we're valuing has little to no liquidity, and the interest in this case has been valued on a non-marketable, non-controlling interest base. Now, what does this non-controlling mean? If you recall, this non-controlling is indicating that we are valuing a percentage of the business that is less than 50.1%, because it is a minority share, minority meaning less than 50.1%. The standard of value in this case is fair market value. Now, that standard of value is agreed to with the client, making sure they understand what the standard of value is, and making sure that it is the correct standard of value for what they're looking for. The premise of value in this case is also listed on this page, and in this case you'll see right here the premise of value is as a going concern. And then we're just going to outline the approach and the scope of work. We'll talk about the fact that a site visit and management interview of the information was provided by Tony Patrick of the firm Patton and Associates. Again, this site visit and management interview typically takes place after I do a preliminary review of the information, the financial information that I obtain. It also may come from the industry reports that are provided by third parties. It also may come from some research that I do on the internet, trying to determine more about this company and develop a list of questions or things that I would like to discuss with ownership. In this section, we're basically saying that this is the information that we were provided and reviewed. Federal tax returns for 5 years from August 2006 to August 2010. And we'll have corresponding financial statements. And then, as I discussed, some businesses require an outside party to complete an appraisal, whether it be of real estate. In this case, it was for equipment that's owned by the business, and the equipment appraisal was provided by a company that I'll call Equipment Appraisers, and that was dated December 29th, 2010. So, and again, this is just more information as it relates to the approach of the valuation report, what we did to complete the valuation. We won't read all of that. Representations, basically, it states that this report was prepared by Patton Associates under the direction of Troy Patton, who owns the company. And then I indicating here that Tony Patrick provided significant assistance in this report, although I'm not signing the report in this case. Also states that there is no obligation to update this report, and there's no obligation to do so if any subsequent events occur. These are all very important, very important statements to be made in the evaluation. The next section is probably the section that everybody thumbs to as soon as they get the report. As soon as the client receives the report, all they want to know is, what is the value? What was the end value? In this case, based on our review of the information, our opinion as of August 31st, 2010, the fair market value of a 1% interest in Father and Sons Construction Company was $25,000. Again, this is a non-marketable, non-controlling interest basis. So this is the end result, but we'll go through and we'll talk about where that information comes from. Another area that is key is the company description. This basically outlines where the company is, what does it do, what are some issues that maybe it faces. This information is obtained through the research that's completed by the valuation analyst. It's also obtained through the management interview and site visit. This talks about what the company does, talks about the facilities, talks about the market that it serves, talks about the industry. And you see here, in this case, it states that the industry is very stable, but it's asking you and the reader to refer to Appendix 2, which is an industry overview and outlook report that's completed by a third party that is referenced throughout this report. Talks about the company's competition and talks about employees and management. Now, this section, in this case, was only, one page. In some instances, this may be 3, 5, 7 pages. It really depends on the business, the history of the business. Has there been a change of ownership several times? Has there been issues in the market that it serves? Have there been issues related to litigation? All of that information would be listed here in the company description area. The next section is basically the income statement. So we're going to get into the meat and potatoes of the financial data. So this is 5 years of historical data from August 2006 to August 2010. This information is obtained from tax returns and the financial statements. The key areas to what we have here is going to be the adjustments that are made, and we'll talk about these adjustments here. We have comparable compensation and owner's compensation. As if you recall, I talked about what would it cost someone to replace the individuals that are receiving owner's or officer's compensation, and we want to make sure that there's fair compensation. So this is where that adjustment's made. In this case, for instance, if we look at 2010, the owners listed, and this could be more than one person, is $348,673, and the comparable compensation for those positions performing those duties is $248,900. So you want to make those adjustments. Interest is adjusted when we're trying to get to EBITDA, and then any other expenses, whether they be discretionary expenses or if they're revenue that's obtained that would be non-recurring, those adjustments are made here. And when we're all done, we end up with a normalized financial statement. So that would give us a good starting point. Here's in this section here, it's just providing some additional information related to the adjustments that are made and where the information comes from. In this case, executive shareholder compensation is adjusted to reflect the normal economic cost of management. Adjusted compensation is based on data obtained from the Bureau of Labor Statistics, which monitors compensation data nationwide. Now, this could come from a lot of different places. It could come from also interview questions with management. It could come from other databases such as salary.com. There's other databases that are available to help the analyst determine what the normalized compensation should be for these particular jobs right here. And then the other adjustments are listed here and why you made them. We also provide various graphs and charts. It just helps the reader get a better understanding of the various trends, whether it be revenue trends or earning trends. Okay, so continuing down through the report, the analyst is going to provide some discussion on the financial statements, the income statements. This section here, this is a key area. This is where the analyst is going to determine some weighted averages, whether it be of EBITDA or revenue or discretionary cash flow. But it's important to understand the weighting process. The analyst is trying to determine if the company, the subject company, as the revenues and earnings have normalized, or if there's some erratic behavior, or if, for instance, some companies take maybe 3 to 5 years. It's a typical business cycle. And so it's important to get an understanding of the operating cycle, the trends of the business, to determine how much weight you are to provide on each specific year. If it looks like the company has normalized and it's some progressive growth, it's not a radical behavior of revenue or earnings, it's typical for the analyst to weight the most recent year, the highest weight, and then a descending weight going backwards. But you may also see where each year is weighted the same. So you'll see here 1, 1, 1, 1, 1 all the way across the board. And that will have an impact, of course, on the adjusted weighted averages. And you want to get a good understanding of why that is, why an analyst has weighted the information, the historical information, the way they did, whether it be equally or descending. Next section here is the balance sheet. Again, it's just information that was obtained through tax returns, financial statements that were provided. And then it's key that you make any adjustments to the balance sheet, whether they be here. This is, we talked about land and equipment, and as you recall, there was an equipment appraisal that was completed. So there is going to be an adjustment to plant and equipment. We'll need to get an understanding of cash of the business. Accounts receivable, you'll see that accounts receivable is averaged about $1.5 million, a little bit higher than that. But then it jumps up to $2.3 million here. This is something that the analyst would need to get a better understanding why that is. It's going to take a look at other long-term assets. What makes up this $1.2 million? The analyst should have a good understanding of that. You, as an advisor to your client, should have a good understanding of these long-term assets. Accounts payable, are they excessively high or excessively low? Are they excessively high as a percentage of revenue? Not just as a number, but as a component of revenue, or a cost of sales. You'll want to have a good understanding there. Short-term debt, and then of course your long-term debt. And you'll see that this company has significantly reduced their long-term debt. And you'll want to know why that is. Is that a goal of the company to be debt-free? What makes up this short-term debt here? Again, you need to have a good understanding of the balance sheet. Another key area is the common size balance sheet, which is basically the balance sheet items as a percentage of total assets So cash as a percentage of total assets. So it's providing historically back the percentage of cash, accounts receivable, and the other assets as a percentage of total assets. And then here's the industry data. This industry data was taken from RMA. It's another database that provides a lot of data to valuation analysts, and so you want to see how the company compares to other companies, the averages within the company, and you also want to make sure that you're comparing it specifically to companies of similar size and nature of business. Liabilities and are also laid out that same way. And then any adjustments that are made. And for instance, here we made an adjustment to accounts receivable, and we made an adjustment to equipment. And then that information, why those adjustments were made, should be specifically listed down here. Why adjustments were made. And then you want to, in this case, we provide a chart of the balance sheet breakdown, how it's broken down. Again, all reports are going to be different, but it's really important to understand that my reports, if I provided the same information to another valuation analyst with the same information related to adjustments, that they should be able to come up with basically the same conclusion of value. Here we're going to provide a discussion of any trends or any adjustments that are made, and then again also weighting particular balance sheet items. This here is just the cash flow of the business. Here's historical cash flow, and then the next section is going to be projected cash flow, and this is where the analyst is going to make some assumptions on capital spending related to trends, working capital adjustments, also decreases in debt, and these adjustments are based on information based on industry data and also obtained from management. And you can see that there's a significant push to reduce debt. Any information, for instance, the company management provided projections to be used for this analysis that they don't, which is not atypical. Sometimes companies don't have detailed projections, and it's up to the analyst to provide that as well. So you want to make sure that that's outlined. Where did the projections come from, and other key assumptions as well. Again, the charts are a really good component of these reports because they're visually show the various trends, and you can see the trends as it relates to earnings and cash flow and revenue. And then also this is a chart basically talking about cash flow, working capital, the various ratios, and I'm sure you all have a clear understanding of those types of things. This is a key area of the report. It's the risk assessment. Again, we're trying to ultimately determine the risk of investing in this asset. And here's where we outline several areas. For instance, years in business. This is an older business that's been in the market for a long time, so it's going to correlate to low risk. Proprietary content, industry life cycle, industry stability, the relative size of the company, and that's within its industry, within its market. This is one of the larger companies, so it's going to not have as much risk as, per se, a smaller company. Company concentration. This one's a key area for this business because this business receives greater than 75% of its sales from its 5 largest customers. So if one of those customers or 2 of those customers were to disappear or to go off and work with another construction company, that would have a huge impact on this business, and therefore there's a high risk to this business. Product quality is excellent. There is some product differentiation. Strength of the market is strong and growing, and again, just lots of different components that trying to determine the risk. of this particular asset. This is also trying to determine risk, and this is related to the financial data, the income statement, and the balance sheet, and how it compares to its competitors, how it compares to the industry, and the risk levels associated with these various financial ratios. And then there's a summary right here, and then we'll talk about the general risk of this business is moderate compared to the industry, and it's an average financial condition. But this information that we reviewed over these two previous pages are going to be key in determining capitalization rates and discount rates, and we'll talk about shortly. Always like to provide a comparative analysis with charts and graphs. Again, they're easy they're impactful visually, and so you want to provide as many of these as possible because it really will help give clarification to some of the assumptions that you'll make later in the report. So we won't go through all of these, but again, this is the company compared to the industry that it serves. The next section is going to be, just talks about the approaches to value. Again, if you recall from previously, there are three basic approaches: the asset approach, the income approach, and the market approach. And this is going to talk about why you did not incorporate those approaches within the conclusion of value. We won't read through this, but you will need to know why the analyst is using or not using a particular approach or methodology. That should be outlined there. Market data, this is key because the analyst is going to use a significant amount of market data, and that market data is transactions of similar companies, whether they be locally or nationally. You know, there are various buy and sell transactions, and that information is then supplied to the various databases from business brokers or accountants or other professionals that have access to the information. And so as a business analyst, you are going to access that information to compare and contrast those companies with your subject company. And so this information here basically outlines what you reviewed. Okay, this next section is the capitalization rates and multipliers. This is where we're going to provide information as it relates to the capitalization rates and discount rates that are utilized. And as you recall from previous discussion, these are a key component into determining the risk of this investment. In this particular valuation, we utilize the build-up method to determine the capitalization rates. Build-up rate starts with the risk-free rate, and the risk-free rate basically suggests that any investor looking to invest in an asset would require a return as much or more than the any risk-less investment. And basically, in this case, we're talking about a risk-free investment, which would be United States Treasury bonds. So we'll start with the 20-year Treasury bond yield, which in this case was as of the valuation date. Now it's key. You want to make sure you pinpoint the valuation date. So in that case, it was 3.52. So we're starting with capitalization rate at 3.52, but on top of that, we're going to add several different premiums. The first premium in this case is what they call the equity risk premium, and the equity risk premium is basically represents the risk an investor accepts for investing in a large public company, i.e. IBM, GE, and it takes the average return for these large public companies over the last 80 or so years, and then subtracts from that the risk-free yield. So that gives you one premium. In this case, the risk-free premium was 5.2. The next premium that's added to that is the size risk premium, and the theory behind that is a small company, which is typically what you'll be valuing, relatively small compared to those larger public companies, the IBMs, the GEs, and all those types of companies. The smaller the asset or smaller the company, the riskier the investment, so there is going to be an additional premium attached to the summations of the two others. And then the next premium is going to be the industry risk premium, which is how risky is this industry compared to the other available industries. And that industry is provided, or that premium information is provided in the Ibbetson's SBBI yearbook. That's published every year, and it outlines industry risk with hundreds of different industries, and so that's where that information comes from. And then the next premium is what we call the specific company risk premium, and that comes from the data that's collected by the analyst. And this is an area of subjectivity, but this premium is developed from those other risk assessment. If you see, if we back up in this area, I hope I'm not making anybody dizzy, but if you go back up to this area here, this is where we are going to determine the additional specific company risk premium, and it's based on the information that you'll get from here. And again, this is a subjective area of the report, and this is there needs to be a significant amount of background information provided by the analyst to back up the fact that in this case an additional risk premium of 3.65% was added. And so if you take those various components and you add them together, it comes up with a discount rate. In this case, the discount rate is 21.7%. Now, the discount rate, from that information, you need to then determine the long-term sustainable growth of the company, because you'll subtract that to get the capitalization rate, which is in this case is 18.7, and then you need to make an adjustment for current year. And again, I'm not trying to make anybody a valuation expert here, but this is information that you'll need to, if you're going to do valuations, get a better understanding of where all of these components come from and how they're utilized. But the discount rate and the capitalization rate will now be used for the calculations or computation of value, which is in the next section here. As I mentioned previously, I like to illustrate as many different valuation methods within the three approaches as possible. And I won't use them all. Sometimes I guess I will, but in most cases I'm not going to use them all. I just need to illustrate them and then convey why or why not that methodology is utilized for the conclusion of value. So here you'll see that we've got 8 different methodologies within the 3 different approaches: asset, income, and market approaches. And so I'm just going to go through those different things here shortly. We'll come back to this page, but those methodologies are then listed here. The adjusted net worth is basically the balance sheet and any adjustments that have been made, and you'll remember that we made adjustments to the accounts receivable and we made adjustments for the fair market value of equipment, so the total of those adjustments are here, giving you an adjusted net worth right there. The next is the liquidation value that we did, and again we're listing all of the assets and liabilities of the company, the adjusted book value, and then talking about what percent of those figures would you realize if you liquidated the company. In this case I'm talking about an orderly liquidation, not a forced liquidation. An orderly liquidation would refer to the liquidation of assets and liabilities over a period of time, versus forced, where you're basically taking what you can get and you've got 30 days or 60 days or 90 days to rid yourself of the assets and liabilities. So in this case we're talking about a liquidation that is over a period of time. Next, we're going to talk about capitalization of earnings, and basically this is probably the most simplistic income method. The capitalization of earnings is, and what that is taking the weighted average of earnings. And if you recall, we talked about how we weighted the earnings of the company, the historical earnings of the company. In this case, we did a 5, 4, 3, 2, 1 weight, and this is the figure, 123,471, and we're going to divide that by the capitalization rate that we calculated in the build-up method, and this is again of current and historical years. Gives us the gross valuation of 680,079. Capitalization of excess earnings is basically a combination of the income approach and the asset approach, because we're taking the expected return of the adjusted net assets. The adjusted net assets are 385,107, and what the reasonable rate of return would be, and subtracting that from the earnings that we talked about up here. And then we're capitalizing those earnings. And you'll see that the capitalization rate of those earnings is higher than the capitalization rate used above. The one above was 18.1%. I believe in here it's 22.41. And that's because these earnings are attributed to intangible assets, and intangible assets require a riskier rate. And it's up to the analyst to determine what that is. And then here's where we're getting into a little more complex methodologies within the income approach. We're talking about the discounted future earnings. So you start with a capitalization rate, and then you need to determine the earnings, EBITDA to cash flow earnings factor. And again, more information that you would want right now, but again, you just get a better understanding. You need to make sure that you're applying the right capitalization rate and discount rates to the right benefit stream. You can't simply take a benefit stream, whether it be earnings or cash flow after equity cash flow after tax, or EBITDA, and apply the same capitalization rate. You need to apply the correct capitalization rate to the correct benefit stream, and so that's why there's some adjustments done here. Discounted cash flow approach, same thing. Price to discretionary earnings. These next two methodologies are within the asset approach: price to discretionary earnings and price to revenue. And what's happening here is we're taking the market data that we received in the various databases that reflect transactions of similar companies, and try to get an understanding of their values and correlate that to our subject company. So you come up with some multipliers. In this case, we have a price to revenue multiplier, giving the value of the company, of an $11 million company, a value of $5 million. So let's go back up here. So those are all the methodologies that were utilized. I want to go back up here to the main summary page of our conclusions of value, and you'll see that all of the information that we calculated on the pages following are right here, and then we need to determine what methodologies would be most useful. In this case, we're not going to go into the whys or why nots, but in this case it was determined that these three income approaches and this market approach should be used for this conclusion of value. And it was discussed with the owners, and they're going to have questions of why a 70-64 value and a $3 million and a $5 million value are utilized. Those discussions have been made with the clients to help them get a better understanding. The blended value is $3 million. And remember, we're valuing only 1% of this business. So we're going to take 1% of this total value, which gives us $30,000, and then we're going to apply the various discounts. In this case, it was determined that a 1% value, you should take a 15% minority discount or lack of control discount, which reduces the value to $25,000, and then you're going to take an additional 3% for marketability, giving you a value of 1% of this company. It's a non-marketable, non-controlling interest of $25,000. So again, there's a lot to it, but that's typically the most interesting number to the owner. But there's a lot that goes into it, and you need to have a good understanding of where it comes from. Now I'm going to go back. I'm going to go down here, because remember when I said that after you determine your value, you want to then do what we call a sanity check. So we're going to go and do our sanity check here. And here's our sanity check, and it's a cash flow coverage sanity check where we take the value, we make an adjustment, and this is for the entire company. So these are before your other adjustments. So you have a 20% deposit required, or down payment required, giving you $2.3 million that needs to be financed, and in this case it'd be financed at 7.5% over 10 years, giving you an annual payment of $335,733. You use your projected cash flows that you completed previously to determine what the cash flow coverage is, and in this case cash flow coverage is 2.9, in the first year 3.58, and based on financial ratios provided by lenders for this particular industry, it was determined that those cash flows would be sufficient. Therefore, we can feel pretty comfortable about the value that's provided above. And then the next several sections are just where you sign off. So a lot of this next section is not really important to what we're doing here. But you want to talk about the conditions and assumptions, any assumptions that you made. And again, all of this information is available in the report, and you can access this report if you'd like to go into it in greater detail. It's online at patentvaluations.com. So again, you can reference this valuation, take a look at it in detail. There's a lot of good information on that website, including some special reports, some various information that we provide as it relates to why a valuation would be needed by your clients, how you can incorporate valuations into your practice, as well as information related to outsourcing business valuations. If you're not comfortable with doing valuations, you're more than welcome to outsource those valuation engagements through our company. There is an opportunity for you to, if you own an accounting firm, there's an opportunity for you to create an income source because you share in some of the income revenues from these engagements. You'll have some work on the front end of these engagements, basically compiling the information, helping with the site management interviews, and answering some questions as we would go throughout the process, and then you would receive a good portion of the income derived from the engagement. So again, all of that information is available on patentvaluations.com, or you can give me a call at 317-581-1776, or email me at tony@patentassociates.com. Again, I hope that this information was helpful for you, and that you have gained a better understanding of business valuations and the components of a business valuation and where the information is derived. So as you're consulting with your clients, you can talk a little more in depth about the valuation process, have a better understanding of a valuation report that your client may have and would like you to review with them. So you are able to consult in value without being a valuation expert. So again, I appreciate you joining us today for the video. And again, if you have any questions, please feel free to contact Troy Patton or myself, Tony Patrick. Thank you.
Okay, thank you. Now that Tony's gone through all the different methodologies and an actual valuation, is what I'd like to share with each of you is how can you become involved in the valuation process. whether it be marketing to your clients, marketing to attorneys. Make sure you read the 3 things every accountant should know about business valuations. You can also work with our firm. I mean, we're more than happy to not only review your valuations, but we will work with you to prepare a valuation for your clients. We sign off on it. We take the risk. We do the engagement letters. What we do is we pay you for helping us to prepare the input sheets and do the site visit for the valuation. So you still maintain the relationship with the client. You don't have to send them to a competitor. You can go out to patentvaluations.com where we talk about the valuations. And our job and what we do within our company is we help other accountants with different aspects of their practice. Whether it be at coachpatent.com or at patentvaluations.com, we're here to help you and assist you and to become not only a better valuator in the process. If you become your own valuation expert and do your own, we're more than happy to help you along the way. Thanks for having us or listening to us for this CPE seminar. And if you ever need anything, please feel free to call us at the number below on the screen or visit one of our websites. Thank you.